What happens when your youngest goes to Baylor as a freshman and their football team sucks? I mean, really bad. You know what? You wear the colors anyway. You wear green anyway. You support your daughter, and you still go to the football games and grin and bear it. Anyway, hopefully they'll win this weekend. We're praying for a win. We need a W column, but it's getting tough. Especially, at least it's cooled off. So at least now you're not in 100-degree stadium.
That's right.
Or not, because they play their games normally like at noon or 1. Anyway, I digress. I just had to throw that out there. So what we want to talk about today is, number one, why headline investing doesn't work. Why, for instance, we got the attacks on Israel and everybody knee-jerk reaction, oh, got to go buy defense stocks. Got to go buy defense stocks. Only a couple look good. The rest of them look like trash. So you don't necessarily want to do that. Also, we're talking about bond market paying. We've been talking about this for the last month, the cost of money and interest rates. Interest rates are the cost of money. And what does this mean for bonds? Because bonds are really on either they're going to go down hard again if we can't tame inflation, or it might be a rip, snort, and rally, and it might be the time for bonds. Is the 40-year super cycle in bonds over? And it already is over. They've been dropping for the last 40 years. And just in the last year, they've rose. I even found an article that said they crept up. Crept up. They skyrocketed. They went from less than 1% up to over 5%. I mean, that's hundreds of % increase. So I don't know where you get the creep up, but we're going to talk about that. And finally, Sam Bankman-Fried, SBF, the alleged stealer, he did it, stealer of client money. His girlfriend, Carolyn Epstein, she flipped on him, man. She said, no, he did it. He instructed us to do it, and he told us to take billions of clients' money. She went on in court under oath and said that. So SBF, he's going to have a tough road to hoe. He's going to have to figure out what he's going to do now. In any event, let's just dive right down into it. Let's talk about why headline investing doesn't work. So everybody wanted to. I mean, I got calls from clients, 4 or 5 clients. Hey, what do you think? Does Lockheed Martin look good, or does this stock look good? Shouldn't we buy? Israel's getting attacked. Shouldn't we start buying defense stocks? So with that, I want to go to Don, and I want to talk about some of the defense stocks. I want to look at that and see whether the actual price matches what people are doing. Are investors actually, is the big money really flowing into defense stocks? So Don, why don't you talk about that a little bit and why headline investing often doesn't work? Usually it's late in the game.
Well, there's an old saying on Wall Street that says, buy the rumor, sell the news. So you really have to split this discussion into things that are anticipated to happen and talked about. Like, for example, if Apple was going to have, when Apple has their September presentations on their new products, very often Apple runs up into that situation, and then all of a sudden they'll come out with the product. The product may or may not exceed people's expectations, but the stock doesn't go higher. That's something that people already knew. The market already knew that was happening. It went higher, and then when the news actually came out, it may not necessarily support the quote-unquote wonderful news that they're describing their products. Now, when a black swan happens, and what I'm showing here is a chart of ITA, this is the U.S. Aerospace and Defense ETF. When something comes out of the blue, that's more of a black or gray swan, because the market wasn't anticipating that would happen. So looking at ITA, this is the Aerospace and Defense ETF. You can see it had the initial gap up, and then the first day of the event, you mark the high, mark the low, a break below the low. This is really no different than an earnings gap up on an individual name. If it breaks below the low of the day, then that's a failure. If it breaks above the high, then it's confirmation. It's certainly no guarantee. But in this case with ITA, You can see we went higher 2 days, and then we went down yesterday, and we're kind of tight in here today. One of the problems with, however, this is several things that you need to think about here. ITA is aerospace and defense. The biggest component, aerospace, is Boeing, and Boeing can't get out of its own way. You can see Boeing gapping down today. So this is going to weigh on the individual components, or it's going to weigh on the overall ETF. There is no pure um, there's the one that we're playing it with was DFEN. I'm aware of the Boeing. It's basically 3 times ITA, and we haven't really made any progress since our entry. This is really where it was on the first day. Some of the individual names are acting better, but are you really going to buy 6 or 7 or 8 stocks? Let's take a look at a couple of them. Here's General Dynamics, first of all. That just made a higher high today after its first move up on Monday, which was the first day that the information came out. Prior to that, and this was the best looking chart. This is why we've been talking about this one in the videos. It had the most relative strength leading into it. If you look at things like Lockheed Martin, this is terrible looking chart, was all the way at the lows, finally just creeping higher on the 5th day after it happened. Northrop Grumman is another one, NOC. This one is following through to the upside today. So relative to where things closed on the first day, it's looking a lot better. RTX is Raytheon. Terrible looking chart, but making a higher high. LHX is Harris. Not above the opening day's high, still inside after the move up. One that we already had in the 21/21 because an aerospace component as well as a defense component is TXT, but it really hadn't made any progress either. So it's a mixed bag. There's no guarantee. So in this particular instance with the news out of Israel, there's a couple other things that you could possibly look at as ways to play the news. Defense stocks aside, there's a big energy component, and we decided to play this both ways. One was with energy, and the other one was with the DFEN stock. Energy has made a higher high since the first day. And gold, a lot of people flee to it as a safety trade. Gold has made a higher high also with a big gap up today. There's also a dollar component to it. There's this inter-asset correlation. You just can't invest in a vacuum. The dollar is coming off, but finally bouncing after a pullback over the last couple of days. And with the dollar being up today, gold and gold stocks are up. That's not normally the way. These usually have a negative correlation, but not today. So you got to pay attention to what the expectation is, and then pay attention to what the correlations are. So it's never a sure thing. Buy the rumor, sell the news. When something comes out of the blue, you've got maybe a better chance to play it. But it's never a sure thing. There is no anything that seems like a sure thing in the market usually works out not to be a sure thing out of the chute. It's what happens the following days after that initial news hits that gives you some clues into whether this might be a lasting trend or whether it might be just an over-exaggeration and things revert to the mean after the initial move higher.
And here's what you need to realize, folks. These billion-dollar hedge funds, these guys that the big institutional money, they've got boots on ground and they're actually doing the research. They know about a lot about what's going to be in the news and the breaking stories before it's being reported. If you don't think they have contacts and people inside the media and inside the government giving them feedback and telling them what's likely to come down, trust me, they know a lot of these stories before they're in the media, and that's why a lot of times you'll see possibly a run up, possibly before it happens. A lot of the news now in this Hamas thing, I don't think that's the case because you probably would have seen defense stocks run up before then, and you didn't see that. In fact, they were in a downtrend. So that was one of the news stories that really wasn't known in advance. It was tougher to know that. But after that happened, you would expect ITA, the defense ETF, just to take off like a rocket ship. And it didn't do that. It didn't do that. And you got more than half the defense stocks still not looking that good. Some of them are starting to set up finally and looking better, but they're a handful. And you got to select the best of the best. So you can't just knee jerk and go out and buy just defense stocks willy-nilly. That's not a good strategy. All right, now I want to go back and I want to talk a little bit about bonds, because we keep talking about this, the bond market pain and in the bond market slaughter. And if inflation, which the last couple days, CPI came in hotter than they thought it was. They kept saying inflation is trending down, but it came in a little bit, not the stuff they like to count. Remember, they like to count baskets of stuff that is becoming more efficient, like computer prices are coming down because they're becoming, technology is becoming more efficient. However, food prices and energy prices, that's the core, that's the one they take out to try to smooth out the effect. The problem is I eat food every day and I drive every day. So those are the two biggest components to my personal inflation, and those are the two things that are going up. In any event, when people realize that when you add back in food and energy, inflation is really hurting people, and it hasn't gone away just yet. And so now they're worried that maybe it's going to be higher for longer. Now, the question, and by the way, I put all these in the show notes. I've got some show notes in there, and a couple of different articles. Two of them are about bonds, and one is the 3 myths about bonds, and then the other one is the 5% bond market pain is headed everybody's way. Not sure I agree with that, but this guy makes a couple of good points. He makes the point that housing market pain, government pressure, the crowding out we've talked about, stock market risk, the office debt time bomb, and private equity deals have gone dry. Pensions are in trouble. Now, the good news is pensions finally might be getting a reprieve, because now they can buy bonds that have a higher yield. And so they can actually, because see, pensions are required to own a big chunk of bonds to match their demographics and their age, their population. And so they had to own bonds last year when bonds were in a bear market going down. They couldn't sell them if they wanted to. That's the problem with the pensions. They're structurally wrong. In any event, it's a good article. You can go read it if you want. But the one article I do want to go over is the 3 myths about the bond market. Number 1, safe bonds are also risk-free. That's right. There's no such thing as a risk-free bond. Even though treasuries, by my license, I can tell you treasuries are risk-free. The government, the regulators will allow us to say treasuries are risk-free. Problem is, it's all about purchasing power. How much money will the bond coming back? You'll get your money back and your interest, because they own the printing press. They're not going bankrupt. But how are you going to get, what is that going to be worth? What's it going to buy? But the safe money is basically, it says safe bonds are also risk-free bonds. That's correct. Federal Reserve policy determines long-term rates. I even had people reach out to me on the Twitter and ask me some question, message me on Twitter saying, talking about the Fed and long-term rates. Folks, the Fed doesn't control long-term rates. Now, they can manipulate a little bit by buying long-term bonds or selling long-term bonds, but they don't generally adjust their balance sheet too much. They did in 2008, and they'll do it some, but normally they'll use the interest rates. But they shorten the shorter end of the curve. Lastly, an aging population means future bond yields will be lower. The theory is that older people will buy bonds because that's what they're supposed to do. The problem is Japan, that hasn't worked in Japan, and they've got a much aging population. So here's the one thing that you need to understand about bonds. Bonds are actually very complicated. They're similar to stocks. So with bonds, you have actually 2 different interest rates. You've got the stated rate or the coupon rate on the bond. So General Electric or any company, Pfizer, issues a 6% bond. They're about to issue it. They're about to issue a bond. Morgan Stanley and Fidelity is going to help them. They're the underwriters. They say, what's the going rate in the economy right now? Well, it's 6% for a bond like you, for a credit quality, AA credit quality like you. So they put on their bond they're about to issue 6%. By the time they print those bonds and get the underwriting and do it 6 months later, and by the time they issue those bonds, the stated rate in the economy, it would just be coincidence if it was still 6% in the going rate in the economy. That's known as the effective rate. So you have the effective rate in the economy, the real interest rate in the economy, and then you have your stated rate on your bond, your coupon rate. If that bond is still, if the interest rate in the economy is still 6% when your bonds are issued, then your bonds are going to sell at par. They're going to go for $1,000. Par just means $1,000 increment, the face value of the bond. However, if interest rates are now at 8% and my bond's only 6%, my bond is worth less than a new bond at 8%, or right, at the going rate in the economy. So my bond is going to sell for a discount. It's going to sell at maybe a $950, not $1,000. What that's actually doing, now that I'm paying less for the bond, I'm getting that stated $60, that 6% a year, that's $60 a year. Now I'm the new buyer of that bond is actually getting a 6% yield because he's buying that bond at a discount. I'm sorry, he's getting an 8% yield. He's getting the going rate in the economy because he didn't pay par for that bond. He paid it. What that's doing is it's setting your bond to the effective rate, the going rate in the economy. Okay? If interest rates drop and they're at 4% and you have a stated rate of 6% on your bond is worth more. Your bond is selling at a premium. So you'll sell that bond for $1,100 or something. That's actually setting a new buyer is only getting 4%, the stated rate in the economy. So the old joke on Wall Street is, what's the difference between a 20-year bond, same company, same issuer? What's the difference between a 20-year bond with 10 years left to maturity at the same interest rate and a newly issued bond by that same company that's a 10-year bond? In other words, they're both 10-year bonds. The answer is nothing. That 20-year bond, even if it has a different coupon rate, as long as the same senior bond, same general bonds, general obligation bond, they're both going to be priced at the going rate in the economy. Okay? So when people tell you you just buy bonds and hold them maturity, that's the message Wall Street tells the retail investors. Real guys on Wall Street, they don't buy bonds and hold them to maturity. They trade the cycles. Now, it's not as active as stocks because you have longer cycles. So you've got a big 40-year super cycle interest rate in bonds normally, 1981 all the way till beginning of end of 2021, rates came down. Now they've started going the other way, and you've seen what's happened in bonds. Last year, bonds had their worst year in history of bonds. They were down more than the S&P. Okay, so normally bonds are safer than stocks, but there are certain time periods, especially when you have inflation. Inflation is kryptonite to bonds. It's worse than rising interest rates. You get rising interest rates and inflation, Katie, by the door, they're going to get slaughtered. Now they've gotten slaughtered. When the Fed stops raising rates, bonds will actually not only have a nice yield, they'll also give you capital gains as rates drop. Are we there yet? I don't know. I wish I did. If I did, I wouldn't be doing this podcast. I'd own the small island of Hawaii, right? But point being is, we'll know it when we see it. We're going to pay attention to interest rates. We're going to pay attention to inflation, and you'll see what bonds are telling us. But here's the main point. Forget about the weekly or the daily movements here. Over the next year or two, once the Fed starts actually finally taking their throat off the interest rates off the economy, and it becomes a little apparent, they start getting a little more dovish. See, right now, one Fed governor comes out and says, I think we're probably done. We really don't need to raise anymore. And someone else in the Fed will say, we probably need one more raise. They're sending a little bit of missed signals because they're trying to stall. They want to kind of feel out the economy a little bit more to see if their rates are actually working, which they are. They want confirmation of that. They don't want to take the brakes off too early because they don't want to have to reverse course and reverse course again. Then they look like they've lost control. Guess what? They already have. We just don't know it yet. This is a confidence game. Now, here's what I'm telling you. If the investors, if people become confident that rates are finally peaked and they're going to come down, stocks and bonds will both do very well. Okay? And probably gold. If rates continue to rise, the dollar will get stronger, you're defending the stronger, but bonds will go down more. So once you think that interest rates have peaked, that's really the time to own bonds. So in any event, I just wanted to address that because I see all these articles right now talking about doom and gloom and the end is near and it's coming, and it might. But bonds, I've heard about this big bond market riot. Now, that may happen. I'll tell you how you're going to know, folks. Don talked about it. Don told you that during fear, during sell-offs, gold and bonds are positively correlated. That's not normal. Normally, they're inversely correlated, right? Dropping rates, a lot of money printing means inflation. That's gold, good for gold, but bad for the dollar. However, when you start raising rates, are strong for the dollar, it's bad for gold normally. However, when you have fear, knee-jerk reaction, people go to treasuries and gold. They both go to those two. Even in the 30s, gold did great. You've heard that deflation, gold doesn't do well. That's not what actually happens in history. Actually, people fly to gold because they're scared to death. And they think that's safer than maybe a US dollar, right? Or the Weimar Republic. People went to gold. You owned the currency, you were done. So at some point, when we have a big sell-off, will people just go to gold and stop going to treasuries? That's when you'll know that there's been a decoupling in the confidence of treasuries. Now, I'm not there yet. I don't think we're there yet. We're in trouble, and we got too much debt, and we got to start paying down our debt and stop spending money like a drunken sailor. If we continue for our deficits to mushroom and blue and go out of control, then yeah, at some point we're going to hit the point of no return, and we're getting closer. But we're not nearly like Japan or even China or even Europe. It's all on a relative basis. So I see all those scare articles and all that stuff, and it very well may happen, and it's going to happen at some point. But hell, Japan's been putting lipstick on the pig since 1991. So we're not quite there for the Great Reset yet. I know a lot of people are talking about it. I follow some of that stuff too. There's some good long-term consequences if we don't fix our problem. But right now, what we're focused on is how do we protect clients and what do we do? Are bonds a buy or sell right now? And our stocks a buy and sell right now? Obviously, disclaimer, nothing's a guarantee. All we're trying to do is enhance the probabilities to put them in our favor. So with that, Don, setting the table, I'm throwing it to you and the team at Revere.
I'll start out with a review of the S&P 500 and what's happened over the last couple of days since we had a lot of our rules are based on the methodology of William O'Neill, which, to summarize it, is buy the best stock leading when the market is in an uptrend. So leading into last Friday, we weren't in an uptrend, we were in a downtrend. So we kind of split our portfolio among passive investments focused on the market indexes and then active investments when the market is in our favor, and leading stocks will outperform the indexes by a factor of 2 to 3 or more if they're true leaders. So with the S&P 500 being in a downtrend by the middle of last week, we had no more individual names in the portfolio, and we were just holding our passive position in the S&P 500 as long as we were holding above the 200-day moving average. That's the black line on the S&P 500, and the reason for that is simple. The market never gets into serious trouble unless the S&P 500 breaks below the 200-day moving average. And if it does, typically the drawdown from peak until you break there is somewhere between 9 and 12%. If you break below there and we enter a full-fledged bear market, since similar to what we saw in Q4 2018 when Jerome Powell was not in sync with what the expectations of the market were, what we saw in COVID, and what we saw in 2022 with the inflation bear market. Once you get below that black line, all bets are off. That's where all bear markets occur. It doesn't guarantee that a bear market's going to happen, but this is where we want to be maximally defensive for our client capital. So we held the 200-day moving average, and then we had this O'Neill follow-through day, which is the signal to look for leading stocks and leading sectors with the market wind seemingly shifted from being in our face to at our back. And we found plenty of good stocks that were acting well, and we started buying them starting last Friday and proceeding through Monday, Tuesday, and Wednesday. Funny thing happened over the last couple of days, though. On Tuesday at 1 o'clock Eastern Time and on Thursday at 1 o'clock Eastern Time. And Dan, this gets back to the confidence in bonds and the confidence in government. At 1 o'clock is when they do the Treasury auctions. We had what was perceived as a poor reaction to the sales of the bonds that they were trying to sell. And we sold off Tuesday afternoon, recovered Wednesday. There was no Treasury auction. We're having a great day Thursday. In fact, challenged new recent highs. And then that 1 o'clock bond auction came out and we sold off really harshly. Bounced into the close, had some follow through strength Friday morning, but then started selling off again. There are a lot of geopolitical, obviously, cross currents to what's going on, but you can't ignore the action of what's going on with the bear market, with yields, what's going on with the dollar, what's going on in gold, and what's going on to individual names. Individual leading stocks held up just fine until they started selling off this morning. So this morning we've trimmed several positions, and this also corresponds with this green line here. This is, I talked in the video last night that when you have a sell-off and it forms a bottom, an inflection point, in this case, the low of 43.25. We're just at that level right now, so it's important to hold that level. Otherwise, we'll get even more defensive. But that corresponds with a break of this green line. We know from historical studies that when the markets and leading stocks are trending above this green line, which is the 21-day exponential moving average, the wind is at our back, and it's sort of a green light to follow through and pursue our discipline, which is put more money into the market, put it at work, lay off of the defensiveness a little bit. But with the feedback that we've gotten Thursday afternoon and then following into this morning with the sell-off, we're breaking below that 21-day moving average, and we're also seeing some of these recent leaders not act as well as they had been working. High interest rates are like kryptonite to growth stocks. And let's take a look at interest rates here very quickly. We'll look at the 30-year bond. And it peaked late last week. Interestingly, it peaked on the day that we had the follow-through day and rates started coming off. They had a big bounce yesterday after that bond auction, and they're down a little bit this morning. They're attempting to bounce, and
Prices.
yeah, the prices are trying to bounce, right, which means the yields are down a little bit. But recently what we've seen is when the interest rates were going up, stocks were also coming down. Now today we've got interest rates down a bit, but stocks coming down also. So that is another reason to be more cautious than we had been since we got that signal last Friday to put more money to work. So we don't like what we've been seeing over the last couple of days. By the end of the day, we may be back above the green line, the 21-day moving average. That's what happened yesterday. We undercut it, closed back above it. We've undercut it again right now, and we undercut and have reclaimed the lows of Thursday. So that's somewhat of a good sign. But we're also seeing leading stocks, the NASDAQ 100, have a below average day today. This had been the leading index. things that lead are entitled to pull back a little bit, but we also use these moving averages as reference points. And the NASDAQ 100 broke below the 50-day moving average today after spending 3 days above it. Is that mean that it's absolutely going lower? No, by the end of the day, we could be back above there. But it tells us that we need to pay attention to our cost basis for everything that we bought. Anything that is hits our stops, we obey our stops. Anything that has had a negative reversal on heavy volume, you need to pay attention to that, possibly sell that. But one thing that is working, and we increased sanctions. We've obviously Middle East, that's always going to spike oil. But additionally, we increased our sanctions on Russian oil products this morning. So energy, after having that initial gap up on the Middle East, is following through and making new highs. The news isn't static. But NRGU is a position that we have, and this is acting very well, up 7% today. So we've got a combination of some things that are working and some things that aren't working. Let's look at real estate. With interest rates going higher, real estate has been in a serious downtrend. It had a counter trend rally, and now yesterday real estate is coming off. So with the failure in real estate, we bought an instrument called DRV, which goes up when real estate is down. So you can see it was up yesterday, and it's up mildly today.
Well,
So
good. I was about to correct you because I was like, wait a minute, we don't own real estate. Quite the contrary. I didn't want you to have people
Right.
think you were buying real estate.
Right. No, not buying real estate, shorting real estate, actually, with that failure. And when you buy these instruments, these inverse instruments, you always look at the chart of the underlying product. These like DRV is called a derivative, meaning it gets its price, it derives its price from another instrument in the market. In this case, it derives it from real estate. Real estate goes down, DRV goes up. Right now, we had a failure with real estate at the 21-day moving average. We use this as our intermediate term indicator. Broke back below it yesterday, and is going further to the downside today. And it's a quick and easy stop. If real estate starts going up above the inflection point, which was the high of Wednesday, we'll be stopped for a very small loss. But it puts the risk to reward in our favor. So we're constantly scanning various sectors. We had a great breakout in semiconductors yesterday, so we got long semiconductors above the 50-day moving average. What's happening with semiconductors today? They reversed and broke back below it, so we stopped out of our semiconductor long position this morning for a small loss. We'll take small losses every day of the week because it's the trend. When you catch a strong trend, it'll pay for all of these little paper cuts that we lose a few percent on. So it's just a matter of sticking to the discipline, paying attention to what's going on, not being a deadlights, accepting what the market is telling you, and
Well, yeah,
reacting accordingly.
so I want to clarify something. So when he says that, little paper cuts and a loss only has, to 2, 3, or 4% loss, he's not talking about on the total portfolio. He's talking about on that individual position, but that individual position will only have a negative 0.2 or 0.3% effect on the total portfolio. So it's small. He's talking about on each position size, not on the portfolio as a whole. One last thing.
Right.
Yeah.
0.2%.
There we go. Now,
is on the total portfolio. That's our target. That's the maximum that we aim to lose on anything that we take. So we can
if
be
you hit your
wrong
stop,
5 times
yeah.
in a row. Yeah, if we hit our stops and we're wrong 5 times in a row, we only lost 1% on the portfolio.
Right.
It's
right. And one other thing,
very small paper cuts.
And one other thing I wanted to emphasize to make sure people understood. Don was talking about the weak demand in the Treasury auction. It didn't go very well, the long bonds. Because people ask me, well, why doesn't the Fed just, the inverted yield curve, why don't they just bring long-term rate, why don't they let long-term rates go up? Or they don't really control the long end. But when it's weak demand, what does weak demand mean? Folks, keep it real simple. When you're talking about prices, it's supply and demand. You've got a lot of supply, prices come down. You got a strong demand, prices go up. So here you had a weak demand, no buyers. Prices come down, meaning bond prices. That means interest rates go up. To attract people to buy those bonds, they got to lower the price to a yield high enough that people will say, you know what, for that, I'll buy that bond. And so that's what we're talking about. So when they say a weak auction, anytime you say the Treasury auction went weak, that means rates are rising. Okay? If it was a real robust, if it was oversubscribed bond market, that means it was bid back down. It was bond prices were bid up. And so yields actually came down. So I just want to clarify that. All right, Don. Do you want to go to the guys?
Yeah. Yeah, let's go to the guys, see what they have for us today. Let's start off with Tedders.
Yeah, so going off what Dan talked about, supply and demand and identifying accumulation distribution, I just wanted to point out three ways I identify institutional accumulation within the base of a stock. So Don, if we were to pull up PDD. And so since we're in the business of coattailing the institutional investors who manage billions and even trillions of dollars, we want to know whether they are buying stocks, accumulation, or distributing stocks, selling them. And so if we were to look at this chart, the first and foremost, the most obvious way to see that an institution's accumulating stock are massive gap ups on volume, especially on earnings reports. So Don, if you're to point to the first one on May 26th, and that one as well, 8:30, and that was even more of an obvious sign that institutional investors were piling into the stock. The second sign I look for is just when you scan across the volume signatures, you want to see what some might consider skyscrapers of blue volume. You want to see up days on larger volume and down days on lower volume. So if you were to go to 526 on that gap up, we had over 26 million shares traded, and then the subsequent days volume tapers off. And then if you're to look at each individual bar, it is dominated by up volume, above average volume versus down volume. And so that is the second way I look for institutional accumulation. And one more thing about this chart before we go to the next one, Meta, which shows it in a clearer way. If you were to go to September 21st, we had that gap down right below those previous lows and the 21 EMA. And then the next day, immediately we gap back up. And to me, that you might be like, oh, that was weak on the previous day, but this is institutions stepping up to the plate and supporting the stock. And so that is one very subtle signature of institutional demand. And Don, if you pull up Meta, it shows it even better on this chart. And there's multiple examples in this recent action. And so if we're to look at August 18th, we moved down and then volume came in above average volume and we closed near the highs of the day. The second day, August 25th, a week later, again, moved down, shook out the lows and closed higher. And then recently, August 27th, no, sorry, not August 27th. In this recent pivot, we also shook lower, closed higher on above average volume. And this is where I was starting to get interested in the stock. Institutions are clearly stepping up to the plate, supporting the stock. And then afterwards, we put in some tight closing days. And then on the follow through day, we broke out. And now we're trending higher, pulling back now. And this is where we have to see if we have abnormal action or normal action. And we just have to evaluate day by day. Just one extra thing, tight daily and weekly closes are also another sign of institutional accumulation. And so if you're to pull up a meta chart, on the daily chart, you can see the tight closes. If you're to pull up a weekly chart as well, you'll see that you have tight weekly closes. And so the three main things I look for are gap ups on earnings or some other fundamentally changing news, strong up days on above average volume, dominating down days on above average volume, and the more the better. And then third is more subtle, but it actually strengthens the base, is a shakeout.
All right, that was awesome, Ted.
Thanks, Ted. Let's go on to Connor now. He's got a couple of slides we can take a look at, and take it away, Connor.
Yeah, so I wanted to show this is like a breadth sentiment kind of oversold, overbought indicator that I've been using as of recently, and I think it can give some pretty good signals and good thing to add to the toolbox and something we're using here at Revere. So basically, this is the bullish percent index. We're using it on Stock Charts, which is a website. And basically what this indicator represents, it's the number of stocks on point and figure buy signals within an index. So it's using the point and figure chart, how many stocks in the certain index that you're using are generating a buy signal. And this calculation is taken by the number of stocks showing a buy signal divided by the total, and that's how you get your readings there. So in that picture, that's the S&P 500. And in the most simple form, above 50%, bulls are going to be in favor. Below 50%, bears are going to be in favor. And then you can look to play the contrarian when you get readings above 70 or below 30. And those two represent overbought or oversold. So in this chart, Don's got up, this is of the S&P 500, and that blue line there, I've marked different turning points in the market, and below this chart is just the S&P 500, so you can see where it was at. And when we're looking at the two most recent examples, on July 24th, this reading generated a signal of 80, so very overbought, and it, when you look to the left, that was also double top, and the market topped 3 days later, and we haven't retested that level ever since. And then just recently, when Don was talking about that area that we bought a few names and we were at the 200-day, this indicator also flipped back below 30 and hooked back up above, and this was on October 4th, and that was pretty much precisely when we bottomed. So these can be good tools, and if you look further to the left on this chart, I mean, the October bottom, this indicator got to 11, put in a higher low, and then came back up. So like anything, if you're in a trending market, these things aren't going to be as useful because a market can keep going higher or lower regardless of what these secondary indicators are showing. But given the environment we're in right now, no real clear trend, these can be super powerful in helping yourself position for short-term moves and, offset certain positions with hedges and whatnot, like Don was talking about with, DRV. So yeah, and you can use, there's a bunch of these for different sectors. If you want to go to the next chart, Don. The next one, it's just one of the NASDAQ composite, and similar thing. You can see the chart, the cues below when this indicator's flashing those extreme overbought signals. More times than not, the cues have put in a short-term top, and you compare this with the RSI as well. You see those when it's living above that overbought level and living below the oversold level. That could give you another piece to the puzzle to try to give you a better read on the market. So, and they have these for all the spider sectors, so you can look at, financials, real estate, etc. So I think this is pretty good thing to add to the toolkit, and definitely helps in market timing.
And the extremes are so important. If nothing else, it tells you don't pile into a bunch of longs when you're already at the top, at an extreme level, and don't be shorting the heck out of the market when you're at an extreme level to the downside. And we use these secondary indicators, and it's like a set of dominoes when they're all lined up the same way, and then they all flip to the opposite direction. You see the market. You see that impact of that when you've got enough secondary indicators, NASI RSI, overbought, oversold, bullish percent, sentiment, all these things that we track. When everybody is on one side of the boat is either going to tip over or people are going to have to go back to the other side of the boat to even things out. And at the extremes, The market doesn't ever go straight up or straight down. It's always going to revert one way or the other, and it's critical to keep the boat at an even keel. Good stuff, Connor. Thanks.
Hey, well, I'd like to add one thing. The point and figure charts. The point and figure charts have actually been around for that's one of the oldest charting methodologies, and they used to do it by hand with graph paper, and it used to take them a long time. And then with the advent of computers and in the 60s, they started being able to do it on computers. And I think, Don, you'd know this better than me. You can correct me if I'm wrong. I think that Bill O'Neill, he was one of the first 8 guys to really start putting charts and graphs on computers. And I think he was instrumental in starting to get point and figure on computers, start doing charting on the computers.
He did charting. He did the traditional charting like we're seeing in MarketSmith, but he wasn't a huge point and figure.
He wasn't
guy,
okay. But that's
but I do. There's a definite advantage to doing that. It takes the time component out of it.
Oh,
it
yeah.
just looks at price, it's X's and O's, and making new highs and
point and figure was very time consuming when you had to do it by hand. Computers made it a lot easier.
Yeah.
Anyway.
All right, Mike, what do you got for us this week?
All right. Can everybody hear me?
Yes,
Okay.
sir.
All right. So I want to talk about a couple things, but don't worry, I'll make it brief. We'll run through this pretty quickly, but the first thing is over the weekend there was an article. Not sure if our viewers have heard this, but if not, Exxon made a deal to buy Pioneer Resources for $60 billion, and they're creating a shale giant. It's the largest acquisition since 1999 when they acquired Mobil. And what this demonstrates is that Pioneer Resources, most of their operations, they're predominantly in the Permian Basin. And what this demonstrates is that Exxon believes demand for U.S. oil production will last for many decades, because they wouldn't make a $60 billion acquisition if they thought oil was done in the next few years. So what's significant about this acquisition and this posturing is that WTI stands for West Texas Intermediate. It's the crude oil benchmark for the US. And that oil comes from this region of the US in West Texas called the Permian Basin, Southwest Texas. And the Permian Basin, what's really special about the Permian Basin is that it produces the highest quality oil. And that oil is called light sweet crude oil. And what that means when you hear sweet and sour crude, the difference in that is the sulfur content. So sour crude usually has around 2% sulfur content, and then sweet crude has like maybe 0.2%. So sweet is much easier to it's just much higher quality, easier.
It's also
refine,
much greener.
Much greener. Yeah, it's just better in every way. So what's special about the US and the Permian Basin is that it's very, very, with the shale revolution that happened in the early 2000s, it's very, very cheap to produce oil in this region. It comes from shale rock, so it's very easy to extract. And it's an extremely resource rich of the highest quality oil. And what's interesting about oil too is that if you look at the rest of the world, there is a lot of oil in regions like Canada, obviously the Middle East, South America, the Gulf of Mexico, but all of that oil is predominantly this lower quality heavy sour crude. So the Permian is the single best region, and that's why Exxon made that big acquisition. And for me personally, it's important. I like that acquisition a lot, and I believe on the podcast I mentioned Oxy before, and as many of you may know, Warren Buffett has a big position in Oxy. I have a big position in Oxy. I like Occidental a lot because a few years ago in 2019, I believe it was, they merged with, they made an acquisition for Anadarko, and they set up the largest shale producer in the Permian Basin. And they're the lowest cost producer, and they've got extremely high quality wells there. And that's important because when you're investing in commodities, at the end of the day, these commodities companies, oil producers, miners, whatever commodity it is, they don't have pricing power. So they're subject to the fluctuations in the market. If the price goes up, they make more money. If the price goes down, they lose money. But when you're investing in these commodities companies, what you really want to look for is the ones that have the highest quality assets as well as the lowest cost of production. And something else that's important, not just for commodity producers, but in general, and I think one of the most fundamentally overlooked metrics when you're investing in any company is management. And management, it's hard to gauge the quality of management. You got to do some research and make some character assessments that are pretty hard to make. I mean, there are some quantitative methods or quantitative measures that you can use to judge management, but it's mainly a more qualitative thing. But Vicky Hollub, who's the CEO of Oxy, has shown really great capital discipline for many years. She's a great leader in that space. I have full trust and conviction in her. So management is a big thing for me, but really for any company, you should always look at management. And yeah, what I was talking about before with free cash flow and all of that stuff. At the end of the day, it all comes down to capital allocation, which comes from the head. So management is in charge of that capital allocation. So that's really important. And then so yeah, that's Oxy, the Permian Basin. In the future, oil will eventually die out. And what's really interesting about this scenario we have now is that we've seen a massive increase in the price of oil, but we haven't seen a massive increase in the rig count. If you look, the rig count has actually decreased. And the reason for this, if you go through earnings calls and listen to management, they're saying they know the government is out to slit their throats and put them out of business. That's a fact that the government hasn't stupidly has not been let's say disguised about. They've been very clear that they're trying to put the oil companies out of business. So instead of doing what they've done in the past where they flood the market with oil, invest all of this money into building more rigs and yeah, investing a lot of capital, what they're saying is, look, we're happy with prices now. The floor is around $80. We've got great free cash flow at those levels. We're going to maintain production as is and return all our money to shareholders because there's nothing else we're really trying to do with it. We're not interested. The government's out to get us. Forget that. So it's a really interesting dynamic. Oil prices, yeah, the floor seems to be $80. We'll probably be there for a while and eventually go higher until oil is done. But with this acquisition, as I said, Exxon saying it's probably going to be a few decades before oil is done. So we'll see what happens there. But yeah, like Oxy a lot in the Permian. And then the last thing I wanted to talk about is quickly some technical patterns. So you may hear a lot online, on Twitter, everywhere. A lot of people talk about these technical patterns and specifically the head and shoulders pattern. And I've seen a lot of sort of misinformation. People don't really understand these technical patterns and they don't work out a lot of the time because they're missing a few things that I think are important to mention. So the first one, an example I want to use, if you pull up AMR on the daily, this is a very clear head and shoulders pattern. It's a shorter time frame head and shoulders pattern. So these usually resolve quicker and doesn't necessarily mean the trend is over. You'll just get a quick correction. But as you can see here in late September, when it made this initial, when it made the left shoulder, it increased on really large volume. And from that peak in volume, you can draw a downtrend line all the way until the break from the right shoulder yesterday, where the volume spiked. And in a head and shoulders pattern, that's the way that the 99% of them that actually work develops. So you've got to have that volume pattern as well as the actual head and shoulders pattern on the chart. And for a real head and shoulders, what you need to see is that big spike in volume on the left shoulder. Then the volume comes down, increases a little bit into the head, but it's not as much volume as you had on the left shoulder. Then it dies out. And then when it finally breaks, you get a big surge in volume. And that's basically exactly what we saw. It's clear as day on the chart. You can even see it with the relative strength line as well. I would avoid this for now. Maybe it finds support. I can get into another video to not keep this one too long. You've got measured moves as well from a break of the head and shoulders, where you can see from a technical perspective where that move should resolve and where it can find support. But that's pretty clear. And then another one, a little longer time frame head and shoulders pattern is DVA. And if you pull up that chart, this one what was like a 1 month head and shoulders. So as I said, it should resolve pretty quickly. But DVA was a more multi-month head and shoulders pattern. And going back to, I mean, the trend, yeah, maybe it started in June, but where I'm really looking at it is in July. So that $100 level, that Livermore level, you had this one isn't as clear. I don't like the volume profile as much, but it's still pretty significant, and you can see now on the break what's happened. But in July you had a run up, then you had high volume in August going to the head, but then it kind of the volume tapered off, and then you got a surge in volume on this break of the $100 level, and now it's at $73. And this one, it could be a long-term top. This is something I would definitely avoid. I would not try to call him on this one. Will certainly take a lot longer to resolve. So those are just two examples of head and shoulders. But I wanted to point out that volume, because whenever I hear CP and shoulders, they don't mention the volume, and that's almost the most significant part. So definitely look at the shoulders patterns. And back to you, Dan.
Thanks, Mike. That was I like that volume part. In fact, I'd like both of you guys, both you and Ted, to do a short little video for Revere University on that. You could do the head and shoulders, and then Ted can do his top. Those were both great topics. I like those. By the way, and Don, do you have anything else on the markets? You're done, right?
No, I just want to reiterate what we're looking for is whether or not we reclaim the 21-day moving average on the S&P by the end of the day, and the NASDAQ 100, the QQQ. Preferably, we want to be able to reclaim the day moving average. We're battling with those levels right now as we speak at 12:43 Eastern Time on Friday.
All right, folks, listen, there's one other article that I did not bring. It's a little bit complicated. It's talking about what is allowed and not allowed in self-directed IRAs and IRAs. In fact, in IRAs, you can actually own physical real estate or physical precious metals or private equity. The problem is you got to get an alternative custodian, because Schwab and Fidelity and those kind of broker, they don't want anything that is not a paper asset. They can't just put in a brokerage account. If it's a physical asset, you got to hold it. You got to get what's known as an alternative custodian. Well, they charge a fee to open up the account, $200, and you got to get $200 every time you do a transaction. But then you have to get an appraisal every year. Point being is it turns out to be very expensive. It also turns what could be capital gains into ordinary income. Okay? You also lose a lot of the things in real estate, like depreciation and other things you wouldn't get. So listen, it's a lot more complicated than that. So before you start doing a bunch of alternative assets in an IRA, call me. I mean, it makes sense sometimes if you're doing big dollar amounts, but if it's not that big, normally the fees are going to eat your lunch. If it's only a $50,000 or $100,000, generally it's better just to own it on the outside and deal with it that way. But again, it all depends on your personal situation. Folks, listen. All the articles and stuff I talked about, we put in the show notes. You can go read on your own. If you've got any questions or any comments, you can always reach out to us. You can send an email to me directly at dan@revereasset.com, don@revereasset.com, Michael, Ted, or Connor at revereasset.com. And you can always call us old school at 855-REAL-WEALTH. You can just go to revereasset.com. Up in the right-hand corner, there's a contact or a subscribe button. You can sign up. This podcast, it goes out weekly, and as well as Don's daily market insight videos every evening the market is open, goes right into your inbox. We won't spam you or reach out to you in any way. It's up to you to reach out to us and tell us you'd like some help. And next to that subscribe button is a contact button, and it sends me an email directly right to my inbox. And you can ask about a stock, or you can say I'd like a complimentary portfolio review, find information about Revere, or just want a topic you want discussed on the show. Revere, we're a fiduciary advisor. We only manage money on a fee basis. We don't do commission things, and there's no conflicts of interest. It's about strategy, not products. Folks, Have a great weekend and stay safe, and we'll talk to you next week on Your Money.
Because it's not about how much you made in the markets, it's how much of that you can keep.